Welcome to the market update for the third quarter. During the second quarter update, the markets had underperformed, but investors also saw glimmers of hope that inflation had peaked and the Fed might pivot to a more dovish stance. We started the third quarter with a relief rally in July, but ended with losses across asset classes. In August at the Fed's Jackson Hole conference, Chair Jerome Powell's messaging was hawkish on squashing inflation and remaining tighter for longer. A few weeks later, the Consumer Price Index report came in hotter than expected, and markets further struggled. You can see the losses in both equities and fixed income on this slide. Let's start with international equities. The losses were much sharper in the third quarter, taking the year-to-date returns below those of U.S. indexes. The MSCI EAFE index was down over 9% quarter to date, with the MSCI Emerging Markets Index falling by almost 11% on the quarter. One of the challenges for international markets is the strength of the US dollar, up over 16% on the year, which Dave Zellner and I will discuss shortly. But what else can explain the relative weakness in international markets? While the US economy feels weak to those of us living here, in developed markets outside of the US, growth is even slower and inflation is higher. Europe is experiencing an energy crisis due to dependency on Russian oil supplies, and this has largely been shut off since February. There's a lot of uncertainty about how the European economy will navigate this winter. This includes the possible shutdowns of manufacturing. In the UK, the recently elected Prime Minister began her term with a tax cut that was wildly unpopular with markets, and it forced the Bank of England to intervene on their cratering bond market. China is still maintaining a strict zero COVID policy, and its real estate market is looking increasingly vulnerable to a shock. In short, international markets are facing the same inflationary headwinds as the US, but also dealing with idiosyncratic events that weighed on asset prices this quarter. All said, there are actually some bright spots. International equities are cheap based on traditional valuation metrics, which our Chief Investment Officer Dave Zellner will discuss shortly. Additionally, the energy crisis is rapidly being addressed with new supply chain development. And finally, the dollar is unlikely to continue its meteoric rise. For long-term investors, we remain steadfast in our belief that international markets offer good value. Turning to the US, this was the third consecutive quarter for losses in the S&P 500. This is the longest correction since 2009 and takes the index back to levels last seen in November of 2020. This is when we were still working from home full-time and before vaccines. Despite an 18% rally in the first 6 weeks of the third quarter, the S&P 500 entered the quarter down 5% and at new lows for the year. The US mid-cap and small-cap indexes ended down 2.6% and 2.2% respectively, outperforming large caps. This is a chart of the S&P 500, where you can see the all-time high on January 3 of this year. In the box at the top of the chart, you can compare several metrics to different points in time. Looking at February 19, 2020, or at the start of the pandemic, the index was at 3386, with a price to earnings of 19.2, and the 10-year yield was 1.6%. Then you can see on January 3 of this year, 2022, the index was 41% higher, with the same 10-year yield, but a PE of 21.4. We closed the third quarter with an index that's sharply lower than the start of the year, now at 3586, a sharply higher 10-year yield, but also a much cheaper valuation at just 15.1 times earnings. While the 3.6% yield on the 10-year is much more attractive than what we've seen in recent years, U.S. equities are also much cheaper on a valuation basis than at the start of the year. Dave and I will discuss equity valuation shortly. Let's look at fixed income. And we'll start with the Fed, which has been very aggressive, with 3 consecutive 75 basis point rate hikes and an additional 75 basis point rate hike likely in early November. The blue line at the bottom of the chart is where yields were at the beginning of 2022. The green line at the top of the chart shows rates at the end of September. My colleague Evan Witkowski pointed out in his recent blog that the difference between interest rate expectations today versus a year ago is staggering. You can see just how much they changed on this dot plot slide. Each dot represents one Federal Open Market Committee participant's projection for interest rate expectations. In September of 2021, the median Fed rate projection for September of 2022 was 0.25%, with the median expectation of 1% at the year's end. The median estimate for 2022 year-end Fed's rate now is 4.4%, with an expectation that rates will peak at 4.6% in 2023. Let me put it this way. Short-term interest rates will end 2022 over 3% higher than was forecast just 1 year ago. It is unsurprising that markets in both equities and fixed income have experienced such drastic declines. The next chart is a great visual representation of how uniquely challenged bond returns have been in 2022. Since 1976, the largest intra-year drawdown was 9%. The worst annual return was negative 3%. Currently, we're sitting at negative 15%. In the US, the 10-year yield rose the last 9 straight weeks of the third quarter. This is the longest period of consecutive week increases since 1994. The longest streak ever was in the inflationary period of 1984 at 12 weeks. The sharply higher yield curve explains the unprecedented losses in the bond market, the worst we've seen in history. But there is a silver lining. Bonds are cheap by all measures. This slide, created by our friends at JP Morgan, shows just how inexpensive bonds are relative to the last 10 years, using a metric called yield to worst. Yield to worst is the worst return received on a callable bond, assuming no defaults. So looking at multiple fixed income sectors, the gray bar represents the 10-year range of the yield to worst. And the purple bar is the median yield over the last 10 years. The blue diamond is where we stand at the end of the third quarter. In other terms, the yield offered by bonds is near the very highest seen in the last 10 years for most sectors, meaning bonds look very attractive compared to the beginning of the year after the carnage of the last 9 months. We're frequently asked about bonds in a balanced portfolio given the very low yields of recent years. Looking at the next several quarters, bonds will again offer yield and income. We also expect that there will be much less correlated to equities once we see more normalized levels of inflation. We know that 2022 is a bear market for equities. How does that compare to historical bear markets and the Fed's response? Let's start with the last 8 bear markets on this slide. In the most recent bear markets, the Fed was able to cut interest rates to bolster economic growth. However, this time the Fed is forced to aggressively increase interest rates in order to temper inflation. I would call this uncharted territory. What we've seen in terms of market moves is also unprecedented. Here's a table showing the last 8 times the S&P closed the year with a loss. The third column shows the return for US bonds in that same year. What this table shows is that historically, bonds have offered positive returns in times when stocks were negative. The exception is 2018 when bonds were flat. But typically, bonds have offered diversification in a balanced portfolio. The bottom line shows the current year through the end of September. With data back 100 years, this is the first time we have seen both bonds and stocks down double digits. Lastly, let's look at a chart of various asset class returns since 2007. The white box represents a balanced portfolio, which is labeled asset allocation, and is similar to the portfolios of the majority of our clients. What this table shows is that for the last 15 years, a balanced portfolio has done what it's supposed to do: provide positive returns, but with lower volatility than had you had just a concentrated portfolio in stocks, bonds, real estate, or commodities. The balanced fund is never at the top of the chart, nor at the bottom. Even year to date, with the negative 19% returns, they're not pretty on an absolute basis. The balanced portfolio is still above the median of all asset classes. This helps show why many of our long-term investors use globally diversified portfolios to fund their mission. This concludes my remarks. Thanks for joining today.